where transmission could well be a big beneficiary. And second is, of course, even electrification in terms of vehicles and the like. So all of that will likely play out in terms of the quantum of transmission capex that will come through over the next 3 to 4 years. And here's a company, Transformers and Rectifiers, which has a 50% kind of exposure to central power transmission utilities, and therefore you have that tilt in terms of the order book as well, and that benefit will likely flow through. In terms of the aspiration, the current top line, and we'll pull out the kind of performance with regard to how the stock has done, and what you'll see is, of course, it's not done too well. We've seen valuations which were elevated, which are now not as elevated. So we've seen a kind of a correction or a sideways move for a while now. 42% down over the last 6 months is how the stock price has reacted. But just in terms of opportunity size, right? This is a 9,000 crore market cap company where the aspiration is to become a $1 billion revenue company by FY29. This is a company which did 2,000 crore, just about 2,000 crore of top line in FY25. So therefore, the tailwind of growth looks extremely strong in that sense. So we'll try and get a perspective at least more near term. FY29 is pushed too far away, but we'll get FY27, 28 kind of numbers and what to kind of expect the company to do going into it. Also, there is plenty of backward integration that the company is indicating, which should add at least 2 percentage points to the margin number, which should take margins from 16% to 18%. And if that were to play out, if both of those were to play out, you could well see very strong numbers being clocked, because on a 9,000 crore top line to do 15% margin for a 9,000 crore market cap company, that will be extremely strong, of course. I beg your pardon, not 15%, 18% margins, because they're currently doing 15 to 16%. So with the 200 bips of margin expansion, that will take it to 18%, which will be very, very strong. In terms of about the company, there you go, incorporated in 94, but was always into transformer repairs even prior to that. It's Ahmedabad based and it's a transformer manufacturer, as the name sounds. What is a transformer? Let's try and break this down a little bit to try and understand it better. It's a device that transfers electrical energy from one circuit to another using electromagnetic induction. That's what it does. The circuit allows for transmission of electricity in just the most layman terms. It allows for transmission of electricity, and it also allows for a change in voltage and allows for AC to DC, DC to AC. So all of that is what our transformer technically does. In terms of product, some of those are in front of you. A furnace transformer is nothing but used in the steel industry. Then there are rectifier transformers, power, distribution. Each transformer has its own use case, and you'll see some of those on your screen. But this one does transformers across the board, including the likes of an HVAC transformer, which is high voltage, and transformers as well is what they take care of. In terms of utilization, well, there's power transmission and distribution. That's one big pocket which it caters to. The other one is the industrial sector, including steel. We spoke about those furnace transformers. That was part of the product line. Let me talk about the capacity now. Currently, the installed capacity is 37,200 MVA, but the capacity can be hiked to 42,000 MVA. Plus, there's a capex which is ongoing, and you're likely to see that come on stream of another nearly 37,000 MVA of capacity, which should come on stream. So you'll have roughly 75,000 MVA of capacity, which should very well be on stream starting maybe Q2 FY27. We'll get a sense of timelines, etc. as well. But that's currently the understanding. In terms of the business model, it designs, manufactures, tests, and installs. It does all four in terms of doing it in this space. The order book obviously gets built up, and all forward revenue is based on the order book of today. Domestic is obviously a large component. I spoke about that, and that's one of the reasons why this one looks decent in the environment that we're in. In-house manufacturing is what they do. They supply to utilities, EPC, industrial, across the board is how their client base is spread. But largely utilities. They've got a large base in terms of utilities. Let's talk about the geography. 90% domestic, 10% export, at least at this point. I wonder if that changes and whether export margins are higher, and if this geopolitical situation lasts for the near term, whether export presents a material opportunity on that 9,000 crore top line that they're targeting FY29. Let me now quickly go to the metrics and try and get you that perspective on what is the kind of growth that the company has done. It's done a 20% growth CAGR, but the real bump up has happened in FY25, as you can see. Outside of that, the revenues were largely flat, so that's something you want to keep in your mind. But what's happened as a result of that is, in those 3 years, you've seen margin uptick that has happened, which is a significant positive. Margins came under pressure as well. That's because of raw material costs going up. But that has reversed now slowly, and you've again started to see the margin trajectory inch back upwards. But for the moment, it's 15.5% on the margin count. But what you saw FY22 to FY24 is margins started going up. So this is, of course, the second metric that we had. We've given this a neutral, but now this will give us a better perspective on what's happened with regard to EBITDA as well. And that is the EBITDA CAGR which has played out. And you'll see how the jump in EBITDA has been quite strong, despite the revenue growth not being there between FY22 to 24. So that's the real perspective that I wanted to kind of give you with this. And you look at you look at profitability as well. It's gone up in very similar kind of trajectory. You've seen good profit growth, and of course that real spike has happened in FY25. Now let's talk about the 9-month period. And the 9-month period as well, we've seen decent traction. Revenue growth was approximately 29% YOY. EBITDA was up 35% YOY, and you've seen 76 bips of margin expansion and a 48% profit growth over the first 9 months of this year. Now let's talk about the operational metrics again for a bit. Margins we were speaking about. Let's also talk about the order book, and it's a good forward indicator of how things are. Currently, the order book stands at around 2.3 times the revenue, and this is of course trailing 12-month revenue. But also, more importantly, the opportunity pipeline is approximately 16,000 crore. How much of this converts is really the question, but there's a very strong commentary coming through that they'll do near 3,500 to 4,000 crore of additional orders that they'll win in this quarter itself. We try and get a sense as to whether that is still doable or not. In terms of the balance sheet, and that'll come up on your screen very quickly, that's how the balance sheet really stacks up. And what you'll see is you've got around 1,400 crore of book value, at least at the end of H1. And then you've got a borrowing number which is small, so really no concerns with regard to the balance sheet. There's a cash bank balance of around 220 crore that the company holds. In terms of cash flow, this has been the pain point for the company. Cash flow conversion has been the pain point. You'd see 48% conversion has happened in FY25. It's accelerated thereafter. But prior to that, it was 20-25%. That's where the real pain point was. We'll try and understand as to whether this is sustainable. It's turning a corner because working capital days have come out effective, but this is reversing. So that's something you want to keep your eye out on. The other piece is the return ratios. As a result, have improved because working capital cycle has improved. So you've seen your return ratios jump up above 15% to now nearly 28% as a result of that working capital cycle improvement. And you've seen that we've given a thumbs up on the back of that. It's maintained 15% even the last 2 years, despite those issues. And that's why we've given this the thumbs up there. So it sort of gives us comfort that there's some floor around the ROC. They won't go below that. We're looking at, in terms of shareholding pattern, promoters holding 64%. There's been some dilution which happened in 2024 calendar year. You also had Madhu Kela, by the way, exit his investment in the company in around the same time. And what we've thereafter seen is a stable promoter holding. Just the equity dilution that's happened is because of fresh equity issuance, nothing else. FIs, DIs participated, and public continues to own around 25% odd at this point. Now let's look at the analyst recommendations. There are 2 buy calls, 2 holds, 1 sell. So it's a very mixed bag with an 11% return potential. We're neutral on this count, and you look at valuations as well. Excuse me. Excuse me. The 1-year forward price to earnings is around 25 times. You've got the 5-year average at 43 times, and the 5-year range between the 19 to 73 times. But mind you, it's been a very high growth phase over the last few years. Can it sustain is really the question, and if it does, then this may well look interesting. We're neutral on this from a sustenance perspective and the kind of growth that we've seen. FY26 to 28, the consensus PAT outlook in terms of growth is around 34%. So you'll have a 280 crore PAT in FY26. The consensus says it will go to 500 crore by FY28. Well, whether they can do it or not, we'll speak with Mr. Chanchal S.S. Rajora, who's the Director of Finance at Transformers and Rectifiers on the other side of this very short break. Stay with us. Welcome back, and we're in conversation with Transformers and Rectifiers. We've given you a perspective on how the company has shaped up over the last few years and what it actually does. Let me bring on board Mr. Chanchal S.S. Rajora, who's the Director of Finance at Transformers and Rectifiers India. Unfortunately, we have him on the phone line and not on video. Mr. Rajora, great having you. Let me first start off by setting the context. Give us a sense of the order wins and the kind of pipeline that's shaping up, because you've got a 16,000 crore order book. The book to bill of yours has shrunk a little bit. Two reasons why. You've accelerated, of course, execution, but also you've consciously won better quality of orders, which means that you want to do better margins, I'm presuming, on the orders that you're winning. Give us a sense on whether that 3,500 to 4,000 crore kind of order book increase can happen in Q4. That's point number one. Point number two, is my understanding right that the quality of orders is the focus, and what is the other reasons why there's been a taper with regard to order book?
Harsh, good afternoon, and first of all, my wishes to you and entire ET Now family on the Festival of Colors.
Wishing you and yours the same, sir.
Yes, and second point regarding the orders, what you have basically asked. Basically, Harsh, look, over a period of last 1 year, we have become little bit choosy about the orders, because the idea is more focus on the margins as well as on the deliveries, because the deliveries are very, very crucial for in this business as of now, and particularly on the high voltage power transformers where we are, because our delivery on our delivery, the entire projects is depend. So we are focusing on timely deliveries and the better margin products. That is the first criteria. The order book has not shrunk. Basically, the order book we ourselves has basically become cautious to having the orders, particularly in the quality orders. That's the major criteria on that. Coming back to the order percentage, you right now has mentioned that we are almost 2.5 times of the order book in terms of the revenue, and that is significantly quite high. And in quarter three, whatever projections we are given about the order, we are bang on that target, and we are sure that that's going to be the order book when we end up the financial year, right?
Understood. And that'll create an unwind on your book to bill, sir. So it'll go up sharply above 3 times, is my understanding.
Yeah,
would that be the right way in which?
That's right.
Sorry,
That's right. That's right. That's right. That's
understood.
That is right. Right. Please understand one thing in this. Please understand one thing, that in our present order book, we don't have any order which is related to our distribution facilities, because distribution facilities, we call it cash to carry order. In 1 month, 1.5 month times we deliver it. So we always take just in time those orders, and that's quite a significant, almost 100 to 150 crore, 200 crore order that we take on just in time basis. Also, this order book does not have any orders related to our new facility, which is coming up in by end of the quarter one.
Okay. And with regard to the opportunity which you're bidding for, it's around 16,000 crore. What's your win rate there? Give us a perspective of that, Mr. Rajora.
Harsh, when you talk about the high voltage and extra high voltage transformers, we have a market share of around 20% in this country, and we wanted to maintain that share in that level. So we are hoping that in this 16,000 is almost close to 12,000 crore to 12,500 crore numbers is, or around 14,000 crore is the extra high voltage transformer segment, and we are eyeing 20 to 25% of that business.
So that's a very strong order outlook. How quickly do you execute? So you'll be at 8,000 crore in terms of order book by the end of this financial year. Let's talk near term. How quickly do you execute that 8,000 crore in particular?
In 18 to 24 months time.
Okay. So 8,000 crore in 18 to 24 months time, and then you continue to add to your order book as well, and the order pipeline is robust enough to kind of support even the beyond the 2 years time frame.
Harsh, I tell you one thing that particularly we are very, very basically confident after this union budget that this tailwind is not now for 5, 7 years. It is there for at least 10 years, right? The new gates are opening up, new opportunities are coming up, and I don't see any doubt that next 10 years belongs to us.
Got it. With regard to your fresh capacity coming on stream, can you give us timelines? Because it's been delayed by a quarter or so. But give us the timeline. You've got a 22,000 MVA. You've got another maybe 15,000 MVA odd. So that doubles your capacity. But give us a perspective on the timeline of that.
Harsh, by end of the Q1 of coming financial year, we will be adding up around 15 to 20,000 capacity in our Changodar facility. And by end of Q2, we will be adding up around 20,000 capacity additionally. So by Q2 and say by H1 end, we will be around 75,000 MVA capacity company.
Okay. And how much does that give you in terms of, and how quickly do you ramp up on capacity utilization? Say by end of FY27, what would your capacity utilization be? And say FY28 end, what would your capacity utilization be on the 75,000?
Our target is by FY28, we should have at least 80 to 85% utilization. And we are working on that direction.
And what would therefore, if you do the 80-85% utilization, what would the revenue be at that level?
Should be somewhere around 5,500 plus crore.
Understood. You're also doing backward integration. You're saying that margins will go up by 200, 250 bips odd. Talk to us about how does this insulate you from raw material pricing? Because that has been a concern, right?
Basically, Harsh, more than pricing, it was the supply of raw material which was the more concern. And that has prompted us to do the backward integration, right? And let me give you a sense of backward integration, what we are doing and what we have done it. We have basically acquired a CRGO processing unit very recently, and that unit is now 100% working for us. In next 3 months' time, we will be 100% backward integrated in terms of the CRGO. And radiators, we have already enhanced our radiator manufacturing facility. We are now up to 765 kVA radiators, 100% in-house we are making up. We are coming up with the CTC manufacturing facility, dependent on the CTC, which is the biggest bottleneck for us, particularly when we talk about the reactors CTC that is there. And we are also coming up with insulation and pressboard manufacturing facility, which will start operation from Q4 of next financial years. And the bushing facility, which is also in pipeline, which will start the production, say, Q1 of next financial year, which is FY27-28. Apart from this, we are also increasing our fabrication facility. Presently, we do almost 40% of transformer tanking in-house, but we are putting up a 4,000 metric ton per month facility, which is going to be the largest fabrication facility in the world. The first phase of that facility will start operation from Q4 of next financial year. With this, we will not only be 100% backward integrated in first half of FY27-28, but also the half of these facilities will be selling it to the our peers or the export, or will be doing the export. That will give us a great advantage in terms of the console books.
Very interesting. Okay, Mr. Rajora, I'm going to have to hold that thought. I have to take a mandatory commercial at this point. I'm going to come back to you on the other side. Viewers, the perspective with regard to how much of this is export, how much is domestic, and how are export margins really is also something I'd want to understand. Other side of this break, just hold on. Welcome back. We still have with us Mr. Rajora. Mr. Rajora, you just spoke about how you're doing plenty of capex both on the finished product front as well as you're trying to backward integrate the entire supply chain. talk to us about the capex that you're putting up for this. Is it pretty much done, or are there some funds which are still required with regard to that capex?
Harsh, as far as capex is concerned, we have already planned it. There is no further requirement of the capex is there. We have formalized everything in place. All the equipments and everything has been ordered, in fact, and civil works has started. And we don't foresee that any requirement of Apex is coming out in this particular projects, whatever we are doing it. In fact, we are working on rigorously to become the debt-free company in next 2 financial years, and I'm sure that we will be achieve that target.
Perfect. Mr. Rajora, talk to us about working capital. The last cycle was difficult for you. Now you're seeing an unwind of that cycle. What gives you confidence that you won't require the kind of working capital, or the cycle will not stretch you from a cash flow from operations perspective this time around?
Harsh, the most important thing you need to understand in this cycle is that this cycle is not depend on one particular requirement or one particular utility. Like earlier, we were completely dependent on the state utilities, and they were very, very bad paymasters, certain utilities. In this cycle, basically, the multiple requirements are there, multiple industries are there, and multiple utilities are there. To be honest with you, the payment terms in all the utilities are now excellent. So we don't have to worry about the payment sides. And if it is a 45 days payment, we bank that on get the payment on 45 days. And most of my EPC players and my industry customers are now on either on the LC basis or on the X-Works basis. So payments is not at all a problem for us. And also we have a very stringent processes in flow in terms of the recoveries and in terms of the receivable cycles, so that we are bang upon on the recoveries receivable cycles. Like I have told my entire team that we are not the financer, we are basically the equipment supplier, and unless we don't get the payment, we will not able to supply the next lot of transformers. So, and even our customers understand that. So that is is the confidence which we are getting, that this is not going to be a problem at all on that side.
Understood. Mr. Rajora, with regard to the World Bank and the kind of embargo they've placed, what's the kind of impact there, and why have they done that? And what are your conversations with them really revealing? Your export focus gets hindered as a result of this? Give us a sense, are export margins better?
Harsh, first of all, there is no embargo from World Bank on us.
Sure.
That is the thing. We don't have any embargo on that. Second point is that as far as the World Bank issue is concerned, it is not affected on our business at all, because we don't deal with any World Bank funded projects anymore, right? In fact, on the fundamental basis in the company, we have decided not to export anything on the FOR delivery basis or site delivery basis. In export side, we are only dealing either exports or FOB basis. And all World Bank funded projects are delivered at site projects. So that is not at all issue for us. World Bank has given us a letter, so they need some explanation regarding a project what we have done in 2022-23 in Nigeria. We have replied them, and we are expecting that it will get resolved by April or May.
And Thank you so much, Mr. Rajora. Right. Please.
Export is concerned, it has not affected anything on us, right? Okay. And particularly, in fact, to be honest with you, after getting this US and European trade deal, we have got a good amount of the inquiries, particularly from US and Europe. Right now, we have almost 1,500 crore rupees of inquiries from US, which we are working on a very, very advanced basis. And since we already supplied last year a few transformers for data centers, we sense that this is going to be a good help for us in coming year.
Mr. Rajora, always very good speaking with you. Of course, that data center opportunity also is very, very large for you. But that's all the time, unfortunately, that we have on AAYC today. Thanks so much, viewers, for tuning in. More action on the other side. Stay with us.